Have you ever stopped to consider how the price of a single commodity, oil, can shake the global economy? Oil, also known as black gold, is a linchpin of the modern world. It's more than just the fuel in our cars or the heat in our homes. It's a symbol of progress, a driver of economies, and a lifeblood of civilization. It's hard to overstate just how much we rely on this viscous black substance. From powering our vehicles to heating our homes, from producing plastics to generating electricity, oil is undeniably intertwined with nearly every aspect of our lives. But oil is not just about the energy it provides or the products it helps create. It's also a crucial cog in the vast machinery of the global economy. Its price, determined by a complex network of supply and demand, geopolitics, and market speculations, can dictate the economic fortunes of nations. A sudden spike or drop in oil prices can send shockwaves through global markets, affecting everything from the cost of your morning coffee to the stability of your job. Oil drives economic activities, not just in the sectors you'd expect like transportation and manufacturing, but also in less obvious ones. Take agriculture, for example. Modern farming relies heavily on machinery powered by oil-based fuels. A rise in oil prices can increase the cost of food production, which in turn can lead to higher prices at the grocery store. And that's just one example out of many. In fact, it's hard to think of an industry that doesn't rely on oil in some way. Whether directly, as in the case of airlines and shipping companies, or indirectly, as with the electronics industry, the cost of oil can have a profound impact on the bottom line. Indeed, the ripple effect of oil prices is far-reaching. But what happens when these prices skyrocket? As we delve deeper into this topic, we'll explore how fluctuations in oil prices can lead to financial hardships for everyone, from the individual consumer to the largest nations. It's a complex, interconnected web of cause and effect, with oil at its pulsating heart. When oil prices rise, the effects reverberate through every corner of the global economy. Picture this. You're at the gas station, and the price at the pump has just jumped. It's not just your wallet that feels the pinch. Higher oil prices mean higher costs for transportation, which in turn means increased prices for the goods that rely on that transportation. So, that morning cup of coffee, it just got more expensive. The new pair of shoes you've been eyeing, those too. But it's not just about what you buy, it's also about where you work. Businesses, particularly those in the transportation and manufacturing sectors, are heavily dependent on oil. When oil prices rise, their costs go up. Some may be able to absorb these costs, but others may have to make tough decisions. This could mean cutting back on production, which could lead to job losses. It could also mean passing on the costs to consumers, which could lead to reduced demand for their products. Either way, it's a lose-lose situation. To better understand the impact of rising oil prices, let's rewind to the 1973 oil embargo. In October of that year, members of the Organization of Arab Petroleum Exporting Countries, or OAPEC, proclaimed an oil embargo against nations perceived as supporting Israel during the Yom Kippur War. The result? The price of oil quadrupled. This had a profound effect on the global economy. There were long lines at gas stations, inflation soared, and economies around the world went into recession. The United States, which was heavily dependent on imported oil, was particularly hard hit. The crisis was a wake-up call for many countries about the risks of relying too heavily on oil. The 1973 oil embargo left an indelible mark on the global economy, but it's not the only time oil prices have rocked the world. Fast forward to the 21st century, and the story of oil and its impact on the economy continues. One of the most striking instances of this was in 2008, a year that will forever be etched in our memories due to the Great Recession. But what role did oil prices play in this economic downturn? Let's take a closer look. The year 2008 was marked by what is now known as the oil price shock. The cost of a single barrel of oil soared to an unprecedented $147 in July of that year. This was a staggering increase, especially considering that just 5 years earlier, oil was priced at a mere $30 per barrel. This drastic surge in oil prices sent shockwaves through the global economy. High oil prices triggered inflation, pushing up the cost of goods and services worldwide. It also led to increased costs in transportation, manufacturing, and agriculture, sectors heavily dependent on oil. This in turn had a domino effect on other areas of the economy, leading to a slowdown in economic growth, and eventually contributing to the onset of the Great Recession. Furthermore, the high oil prices exerted immense pressure on households and businesses alike. With the cost of energy skyrocketing, consumers found themselves with less disposable income, leading to reduced spending. Businesses, on the other hand, faced higher operating costs, which resulted in decreased profits, layoffs, and in some instances, closures. In essence, the 2008 oil price shock served as a stark illustration of how deeply intertwined the global economy is with the oil market. When oil prices soar, the ripples are felt across all sectors, affecting everyone from the individual consumer to the multinational corporation. The 2008 oil price shock was another stark reminder of how vulnerable our economy is to oil price fluctuations. So, what does this all mean for the future? As we look ahead, it's clear that oil will continue to play a significant role in our global economy. Despite the push towards renewable energy, the world's infrastructure is still largely dependent on oil. If oil prices continue to rise, we could see an increase in inflation, a decrease in consumer spending, and potential economic instability. Imagine a world where oil prices have doubled or even tripled from today's rates. The cost of goods and services would skyrocket as businesses struggle to accommodate these increased costs. Airlines, shipping companies, and manufacturers would all face significant financial strain. In turn, this could lead to job losses and wage stagnation, impacting households around the globe. But let's consider another scenario. What if the world makes a concerted effort to shift away from oil and towards renewable energy sources? In this future, the economic impact of oil prices would lessen. Businesses would no longer be at the mercy of fluctuating oil prices, and consumers would benefit from more stable prices for goods and services. However, this transition wouldn't be without its challenges. There would be significant upfront costs to build new infrastructure and develop new technologies. Job losses in the oil industry could lead to economic hardship in regions heavily dependent on oil production. But in the longer term, new jobs could be created in the renewable energy sector, and the economy could become more resilient to energy price shocks. The question is, are we willing to endure short-term pain for long-term gain? How we balance our reliance on oil with the need for sustainable energy will be one of the defining issues of our time. The price of oil has shaped our past and present. It's up to us to decide how it will shape our future.